Welcome back to another Market Insight Call where we sift through the noise, get to the signal, give you actionable advice. We are back again, which seems like a really fast month as always.
We're 1 month away from being able to wear the seersucker.
Oh, well, I was thinking you were going to do that today. Well, we typically joke about, not much happened this month and really dive in. There's a lot that happened, but actually this month was actually pretty quiet.
Right?
Pretty quiet month, so we'll show an S&P 500 chart of what that quiet month looks like. We had FOMC meeting, some payrolls, get those most months anyway. We'll go through those. You'll give us a deep dive on yield curve, market breadth, participation of stocks. We'll take a look at that because it's starting to perform well. We'll look at earnings. We have a nice dashboard we can show on how we measure earnings. And then close with something fun, maybe your favorite meme stocks. They are back. So let's start with the S&P 500 chart. This is a simple chart just looking back over the last month. It's candlesticks. So again, when it's red, you opened at the top of the body of the candlestick, closed at the bottom. And when it's green, you opened at the bottom, closed at the top. So when we look to the far left of this, these are weekly candles, so we get an idea of what happened each week since the last month. We were dealing with the tensions in the Middle East. And when we looked at the market last month, we really said it looked like the market wanted to recover. It looked like the market wanted to rally. We just had to get past some of those geopolitical tensions, which we did. We got through those, and the next couple weeks were a rally. The next week, starting on April 22nd, that's when earnings season really started for a lot of the big names. Earnings were strong, helped the rally. We get to the middle candle where we had a Fed meeting, and it was not as hawkish, not as scary as the market was expecting, and that's really given us the last 2 weeks to really move a little bit higher, drift a little bit higher, because we're only up about 1.5–2% over the last month, and it was a pretty boring month. But the news we got from the Fed meeting really started with how they're handling their balance sheet. So the chart I have here is the evolution of their balance sheet since 2018. It starts at 2018 because that was the last time they were rolling off bonds. They really had a stable balance sheet from 2014 where they really kept it pretty level, were reinvesting the bonds as they matured, and started the quantitative tightening in 2018 until 2019 when there was an issue in the reverse repo where they thought they pulled out too many reserves. Interest rates were shooting up on the short term, and that's when the balance sheet starts to increase again, get to COVID, and they bought every bond they could get their hands on. And they continued buying bonds up until 2022, far longer than they should have. And we've been reducing it steadily over the last 2 years with a jump in there, which was the bank failures in 2023 in March. And they've been reducing bonds. They had a cap of how much they were going to pull out of the system. Been pulling liquidity out at about $95 billion per month was their cap, which was 60 in treasuries, 35 mortgage-backed securities. They never hit the mortgage-backed cap because there's no principal payments coming, not a whole lot of prepayments, about $15 billion there. And this was the news from the last meeting. They reduced their cap on how much money they're going to be pulling out of the system. They said now it's going to be $60 billion they're going to pull out of the system. So they reduced the treasury cap down to 25, and then the mortgage-backed stays the same, so about $15 billion is what will actually hit. So they're really only pulling out $40 billion a month, pretty low amount when they have a 7.5 roughly trillion balance sheet. So they're not going to be reducing that balance sheet at a significant rate. This was actually lower than the market was expecting. This helped the market. It's supportive, and the functionality of it will actually support markets, right? If they're not pulling out as much liquidity in the system, that's a good thing for markets.
Well, not only are they not pulling out as much, as if we just go back to pre-2020 and look at where we are now, there's still an enormous amount of accommodation that has been provided to the market over that time. So they're just slowing down their growth to the point that it's still quite a significant slope on money supply growth if we look over the long term.
The other point we got was interest rates, which was we didn't get much. So we had a change in the balance sheet, and Powell made it very clear they weren't looking to raise interest rates because the narrative for the last few CPI readings was a little bit high, PCE readings as well. The market was starting to think maybe they'll have to raise rates once to slow down some of the inflation. It didn't even acknowledge that, said rates are at a really good spot now. They can hold them here if inflation continues to give them problems, or they can cut them if inflation comes in lower than expected or really comes in as they're expecting to move its way down to 2% over the next 18 months. So we really got no change here, and that's all this slide shows. We haven't shown this slide in a long time. It's the Fed fund futures markets. It hasn't been a good predictor of where equities have priced or moved at all. But when we look, the market on Fed funds futures is expecting about 1 to 2 rate cuts throughout the year, with a 10% probability on the far right there of no change, which is probably pretty accurate. I think we talked about last month, it could actually be higher probability of not needing to cut rates throughout the end of the year. But if we look at the bottom panel, all those numbers of what had changed over the last month, not a lot of change. So really the market had no change in what they're expecting on the short-term rates. So it was mainly just those balance sheet changes. But as that discussion was happening, what we're looking at here, this is a full year-to-date chart on the top panel of the S&P 500 with the green upward sloping since those last few weeks that I was talking about. The bottom panel is long-term interest rates, 10-year Treasury. That becomes our discount rate for cash flows. And that has been coming down. So we didn't see much change in the short-term rate. Long-term rates have come down through this equity rally, certainly supportive of equities, because when you discount back at a lower rate and you're discounting the same cash flow, expectations for where stocks are going to be returning cash flows has not changed. So we stayed neutral on the top of our equation, bottom came down, higher equities.
That makes sense.
You want to go through the yield curve?
Yeah,
I know
I
you've been
think-
looking at this a lot.
I think long-term listeners know that we look at the yield curve. We think it's a really good indicator. It has 100% predictive power historically. I'll put that historically in there for a recession. And a lot of economists continue to point to this. And I've gone back and forth with one of them. I respect him. I won't use a cheap shot, and it's not Dr. Newman either. But I think that the theory on why the yield curve is predictive makes sense. I don't think we actually have a negative yield curve because a lot of people are looking at the 10-year Treasury versus the 2-year, and I think that's a really good proxy. A lot of times you have to go to the bank's window, and that's the FOMC rate that the Fed is talking about, to borrow money. And what happens is as your long-term funds that you've loaned out go below what you will pay for your short-term deposits, banks begin to have a liquidity crunch. And then they start to unwind and call, and then we get a recession. And I think that makes sense. And it's not correlation, it's causation. There's a predictive component of the yield curve. The thing is I don't think that's what is happening in the banks. I don't think their yield curve is negative. So if we're looking at the top part, it's the 10-year minus 2-year. But if we look down below, that's the 10-year minus what banks on average are paying. And we can see the difference between that bottom blue line, very low. 47 basis points is what on average banks are paying on their deposit rates while they're able to earn a significant spread by loaning out long term. So they're not having a liquidity crunch. I think we're looking at that whenever we're talking about COVID and the expansion of the money supply. Yes, it is starting to pull back, but there's still a lot of money in there. And it's not a scarce resource for many banks. Now, there are certainly, you can cherry pick them, local banks that have had to deal with some of the things that we've talked about months ago where they don't have that Fed backing. They're still having to chase deposits and pay high premiums, but most banks aren't. So I would say that a negative yield curve is predictive. I just don't think we have one in the banking industry. And I'm going to go out on the ledge, if that's the case, that maybe we're not going to get a recession off of this one because they're looking at the wrong proxy.
And not a lot of people are talking about that, right?
No, they
aren't.
aren't.
Emailing all the economists that we work with and telling them, hey, can you take a look at this? And I know it's been difficult to get them to come and discuss this.
Yeah, no, it's I think everyone is just programmed to think 10-year minus 2-year, and they're forgetting that that's a proxy, that they need to look underneath the hood and find out what's really going on there. And I think when you do that, you realize the banks have plenty of deposits and they have plenty of short-term liquidity, so they're not going to need to raise rates or call loans, which is what I typically see whenever we have a significant correction.
One of the things we've said for a long time that's been in our outlook deck internally is the next strong bull market, not just 1 year, but talking about a multi-year return in the market. You really need a strong credit cycle, money supply growing again. And you reference this chart that I'm going to pull up now. The dark blue line's M2 money supply growth, year over year change, and going back to 2014, pretty stable in the 3 to 7% had the large jump in COVID, then strong decline since then, where we went negative on money supply growth.
Right.
And you've talked about it multiple times that negative, we still are working through a lot of excess cash, and it didn't flow through to be extremely negative, but we're starting to bottom in that.
Right.
And we talked that the Fed is going to be reducing the amount of money they're pulling from the system. So that is actually a good thing for money supply growth. It's a bad sign for inflation, though.
Yes.
These are I have inflation in the lighter blue line, and they're certainly correlated, and there's
Sure.
obvious causation now. Money supply growth is starting to pick back up. So is inflation.
Right. The only thing that could really offset that is an expansion of productivity beyond what we're getting an expansion on the money supply. So if productivity is increasing at 5%, money supply is at 3%, you're not going to feel as much of effect, maybe even none. You could still have lower inflation on the things that you're paying. But the other thing that I would say is, yes, the Fed is slowing down their money supply growth to the point that it's pulling some money supply out. But notice we still see an uptick in the overall money supply. This tells me that the banks are lending, and once again, getting back to, hey, they have a positive yield here. They have the ability to go out and create loans, which is the other way money is created in the system. So I think that is kind of basing that argument that I just made on the yield curve. This is evidence that's what's happening.
Mm-hmm. And over the last month, we've actually had a significant increase in breadth, so participation in the market. Several ways you can measure it. The way we're using it here, a lot of people use advanced decline metrics. I'm just using percent of stocks in the S&P 500 that are above their 200-day average trend. And right here, it's about 77% ticking up higher. The average is somewhere in the low 60s. So more stocks are trending upwards in the long term than an average, which that's going to mean a few things. It's going to mean there's shifts within portfolios, right? We've underperformed the last month as some of these changes have happened. We've underperformed as international markets have performed really well on the extremely short term. A lot of it we think is a catch-up trade, technical bottoming, not prepared to talk about real fundamental reasons to be making large changes. International markets have underperformed significantly over the last 12 to 18 months. So some of this is just catching up on some of those large changes. But the one thing to note on the trends is if we take 2023 and we look at the way we measure our signals, emerging markets only outperformed and had a positive buy signal in 2023 one time. That's what we're looking at in the center chart here. And the average duration that lasted was only 2 months. Mm-hmm. So if we're looking at what's happened recently, well, it hasn't been a long-term trend. I think over time we will see long-term trends as market really broadens out, but at least now we're not ready to say this is it.
Right. Now, what I love about this strategy is we were underweight China, right? And then all of a sudden it's hurting us. It's like, just stop the bleeding. Let's get close to benchmark neutral and find out what happens. And if it continues to, then the signals will start to say, well, get rid of your narrative. It's not working. Let's start to look at this and re-examine it and start allocating because there's something else here that's going on. So that it's a slower pace, but then you don't have to worry about underperforming for a long term because it's pushing you into something of a more neutral stance on that. So I love this position, but I think you're right. I think we're going to see in a couple of months this is not matching fundamentals, and that starts to roll off. And then we didn't make a big bet either. We're just going to be able to step back into our previous positions or the new positions that are the leaders.
The same thing happens with international developed markets. Last year, that trend was also only one time where it broke out as a buy signal. It lasted a little bit longer. Some of that was an energy trade where you get some of this move into large value stocks, which are a larger weight in the international index. And another way to measure what's performing well is just with the same thing, but with our sectors. And when you rank and you look at the top 5 sectors, utilities, staples, industrials, financials, energy, not names we've been overweight industrials for a long time, but other than that, underweight a lot of these other sectors. But what's not underweight these sectors is the international markets. They're about 20 percentage points overweight compared to domestic markets when you look at these sectors. So not a surprise, you're going to start to see a little bit of excess return coming from those international markets when they have that asset class weighting compared to us.
And that means that we didn't have to undo a lot of our domestic weighting. If we just overweighted those value components on international, it helps the overall portfolio kind of balance out. So if this continues as a trend, we've captured a lot of that.
And to get to earnings now, going back domestically to the S&P 500, the average, we're about to close out earnings season, and we still have a couple big names that are important that we'll show here in a second. The beat rate above earnings expectations was 78%, so a good number, slightly above the long-term average by a couple percentage points, but still good numbers. Companies were responding well to the beats. Apple had a really strong rally after their numbers. When we look at how we measure these, we look at our moat strategy that invests in individual stocks. We have the names on the left, their sector, and on the right, it's how they do against their expectations. Mm-hmm. A lot of green on earnings, so we did have a couple that underperformed our expectations, but for the most part, companies were beating their numbers. Amazon, Alphabet, significantly beating. Apple had a tough number, but they set a record on their amount they're issuing for buybacks. Pretty strong rally out of some of the tech names as well. So some of what we were talking about in the trends, which are a couple months of trends, are starting to unwind in the last couple weeks. So it is short term. That brings us to the fun part.
Oh,
yeah.
The meme stocks.
The meme stocks.
Roaring Kitty's back?
Roaring Kitty is back. Keith Gill, credited with the starting of this in 2020, 2021. I don't know a whole lot about this, but when we look at his Twitter, his last tweet on the left, he posted a 53-second video of a bunch of cats falling asleep. And that was the last video he posted for a couple years until earlier this week where he posted, I guess it's someone getting alert.
Yes.
Starting rallies in the markets, wondering how silly tweets can do this. You look at the first comment under the rally, it's, hey bro, what are we buying? So people are actually going on here and buying some of these stocks that they used to based on Rory Kitty coming back.
This is, for a long time there was this active versus passive argument, and I think this one shows that the market isn't completely efficient, right? There are some inefficiencies here, because if you can move these stocks with a Twitter post, what's going on there? It can't be just what are the fundamentals of the company and all that's priced in. There's something else.
And GameStop back in 2021 had large weightings in some of these passive indexes, and they have their rules based. They can't sell them. They have to just sit with the volatility that was happening in some of those indices. And we look here at the last 5-day returns from the two favorite meme stocks, GameStop and AMC, 100% and 200% for GameStop. Some of that's probably going to come back out. And we already saw from AMC, they issued some stock, which is what they should do.
That's part of this story is that there's a lot of people short, meaning that they've sold the stocks, that they would need to buy it back. So I love AMC's approach is, well, let's just increase the supply of stock, get the money from this. We can take it. Hopefully they reinvent themselves on their business model. And this is a way for them to cash in on some of these stock prices that are overvalued and do it. But then this actually resolves the problem of excessive shorts on the stock, because now they increase the supply and then those stocks could be
Do you think
purchased.
this has any impact on markets? Anything?
No, I don't. It's probably not a complete coincidence that we see money supply beginning to tick up and this is moving up. I don't think it's anything like what was created in 2020 and 2021. So I think this is short-lived, especially if AMC, and if I was GameStop also, begins to issue the stocks and take advantage of this, which means that there's a lot more supply and you don't have people rushing for the exit to buy that to cover their shorts.
So the one small thing that it can affect relative performance for us, because we're not investing in things like this.
Right.
The benchmarks that we compare ourselves to have some low-quality names in them throughout the portfolio. Low-quality names have higher short interests. These are short squeezes. There's going to be some short covering in some of the small mid-cap indexes. So you may see some underperformance as the small and mid-cap indexes start rallying a little bit more than the rest of the market. Be small, a handful of basis points, but that's really the main impact we would see. And actually remember going back when we did a podcast with Jeremy Siegel, professor out of Wharton, and we talked about this during the mania of it in July of 2021, and we asked him, is this, from central bank policy? And he didn't really want to talk about it. So his view was no, it's just kids having fun. And I tend to agree with that. I mean, it wouldn't be happening if you were in recession, though.
Right.
But this is their way of gambling. And a lot of people talk about the stock market being gambling. Exact opposite. The longer you stay invested in the stock market, odds of winning go up. versus gambling the other way around.
Well, sure, it's always your approach, right? And it's what's your strategy? Because if it is just short term, it is gambling. It's the fundamentals win out long term, and you got to hold that strategy. Long term, you will beat the house if you just stay invested. But short term, that's not the case.
Yeah. Anything else you wanted to do to close out meme stocks?
Yeah, just show the roaring kitty and the waking up kitty, I guess. I love the meme, and I think it is fun. And I actually think that these guys do bring some value to the market, but I would not be, it's not investing to follow this.
Right.
It's speculating for sure.
Well, thank you for joining us. Go ahead and hit that like button and share it with someone that you think will find it useful. We'll see you next month.